let's get started. How long did the homework take? More or less than an hour? Less. Okay. We'll go over real quick. First question said, 2 years ago, an investor bought 100 shares of a mutual fund at $18.50 during the 3-year period. Is that right? 3 years? That should have been 2-year period. Oh, nobody emailed me? You guys use 2-year or 3-year when you got to the end? 3? Oh, I gotta correct this. She received total income dividends of 62 cents per share during the 2 or 3-year period, depending on how you read it. She also received a capital gain distribution of 50 cents per share. And at the end of 3 years, oh, really, did it say that?
Yeah.
Man, she sold her shares for $32.80 a share. So there's all three possible incomes from owning this mutual fund that we talked about last week. The first one, income dividends, 62 cents a share times 100 shares, $62 during the period. Next, the capital gains distribution, different than capital gain. 50 cents, 100 shares, $50. So there's two possible incomes. Then there's the capital gain because the price was higher from selling it than what it was when this person bought it. $32.80 selling it, is that right? $32.80? And buying it at $18.50 is an increase of $14.30 times 100 shares.
It should be $14.30, $1,430. Yeah, yeah.
Again, yeah. Times 100 shares. There we go, how's that?
Yeah.
Yeah, I got lots. Before I post this, I'm going to have to make all kinds of corrections. $1,430. That's crazy. So you add all of them together. The dividends, capital gains distributions, and the capital gains. Let me add a 0 here. Let me add a 0 here. Now does that look right? Or did I miss it by adding that 0? Huh? I did, didn't I? So someone give me a total of 14. That's 2,000, 2,050. Is that right? No, 1,550, and then another 2. 1,552?
That was 42.
42? Thank you. 1,542. Does that look right? Save that. How much was invested? So there's our total gain, total dollar amount. The question says, what's the total dollar amount made on this investment or gain or something like that? It's adding the numbers together and getting that total. But then if it says percent of total return, which I got to correct obviously, it would be that total gain, $1,542 divided by the initial investment. You always can get the initial investment by taking the price in which the shares were bought and the total number of shares. So this all started with spending $1,850 and getting $1,542 back over. Now you said you used 3-year period. Does everyone use 3-year or 2-year? 3. Okay, so I got to divide by 3 once I get this calculated, but it should have been 1,542 divided by 1,542 divided by the initial investment of 1,850 gets a very high 0.8335. Wow, 0.8335. Does that sound right?
Yeah.
All right. Now I divide by 3 years because it's asking for the yearly yield. So if it's over 3 years, you got to divide by each year. So divide by 3. Divide by 3 equals 0.2778, or about 0.2778. I don't hear anybody agreeing with that one, which it would be 27.78% per year. That's unbelievable. That's a great return for that small investment. You can see I made a mistake here. First of all, I made the gap between what it sold for and bought for way too wide.
Yeah.
But everybody got to this point? Does everybody see the logic behind how to get it per year percentage? That's the key. The amount total you're probably going to be asked for, and then the percentage per year. So there was the tough one of the two, I guess. This one's asking you for the commission on, is it front end or back end here? Front end, the investor invested $6,000 into this Invesco Solar Mutual Fund. It's a sector, obviously, mutual fund in the solar sector. The fund charges a 5% commission when shares are purchased. Calculate the amount of commission this investor must pay. It's the amount being invested times the percentage. I made it a decimal, 0.05 is 5%, so it should have been $300. And then the last question was net asset value. This was pretty much a review because you did this on your in-class assignment. Total assets minus total liabilities first, then divide by total number of shares. And you should have gotten 850,000 minus 10,000 is 840,000 divided by 30, I'm sorry, that's all millions. 850 millions minus 10 million is 840 million divided by 30 million shares is $28 per share. How's that? Easy? Everybody, you will for sure, without a doubt, have a net asset value on your next quiz. And for sure, where's that first question? Total amount and percentage per year will for sure be on that next quiz. If this one, number one, is not on the next quiz, it will for sure be on the final. So you have this question in your future at some time. So this is one you want to put a star by, have it, make sure you have the logic figured out. And the only thing I have to do to fix this is take the word 3 right here, correct? Is there anything else I have to do to fix this? Is that it? 3-year period? Well, I really believe that. All right. So now I'm going to post this answer tonight. Have it printed, ready for your quiz, or however you usually do it. Chapter 12. Stocks. This is the stuff we're talking about on Investopedia. After we get done with this chapter, we're going to go back to chapter 3 and just go, in order. We jumped forward all because you happen to be involved in that game right now, and because mutual funds is one of the most important subjects of this whole class, because almost everybody in here is going to have to deal with mutual funds in their life, in their future, so I wanted to make sure you understood those. Now we're talking about individual stocks. There's some people in this room who are going to say, wow, I'm going to be a saver when I get out there and start making more money I've ever made before. They're going to save, and you're going to go, okay, I have my retirement going where I work, and I'm putting in exactly what I need to put in to get all the matching. And you got that getting larger and larger. And then you're going to say, I want to do some investing. I'm tired of not hardly making any money on my money in the bank, so I'm going to start buying mutual funds. And you go between you and the mutual fund company. And then you're going, I'm ready to take some real risk now, and I might buy some individual stocks. This is what this chapter is all about. You're going to be buying individual stocks. And so there are 2 types of stocks. There's common and preferred. If you buy shares of common stock, you are part owner of that company. If you buy shares of preferred stock, you're basically lending the company money. You are not owner. Anybody hear the difference? Common stock, if you own common stock, you're going to, like once a year maybe, you're going to get letters in the mail. They're going to bother the heck out of you. It's going to say, here are the important subjects to vote on. You have 100 shares, you get 100 votes. How's your vote? Because you're part owner. And when they have the annual meeting, then some of the most important subjects are voted on by the shareholders. And they're assuming you probably won't come to wherever the company's at for this big meeting. Very few do. Just, the biggest investors show up and put their votes in at the time. So they want you to put it in advance and mail it in. And one of the most common things you're going to have to vote on is who is going to be on the board next year. And you're going to look at these names, you're going to say, how in the heck would I have any idea who to vote for? And unless you own a whole bunch of shares, my advice to you is check the box that's called abstain. Which means, I don't know any of these names, I don't know who to vote for, and don't just take a guess. Because you could be changing the future of that company if a whole bunch of people just start guessing without knowing anything about it. If you just abstain, then they won't bother you anymore. They'll say, no, you don't want to vote for who's on the board. That's fine, we understand. Allow the large shareholders decide who's on the board unless you've done the research. Because whatever their best interest is on getting whoever's on the board, they probably have your best interest in mind also because you're a shareholder just like they are. And they want to make as much money off their investment as you want to make money off your investment. So allow them to decide, unless you decide to do the research and learn about the people that are possibly going to be on the board, and you feel confident you can make a clear decision on who to vote for, who might take that company in the direction you think it should go in. So that's the advantage of owning common shares, is that you are part owner and you do have a right to vote on things that come up. One vote is available for each share. So if you only own 100 shares out of 30 million shares, as you can see, you know, you have very little power as far as your vote's concerned. What a lot of companies will do is the original owners, when they go public, don't want to lose control when it comes to voting on things. So they always keep at least 51% of all the shares. And they allow shareholders to buy maybe the other 49%. So that when a vote takes place, if the original owners have 51%, their votes will count 51% towards any subject being voted on, which means they keep control of the company. They get control as to who will be the president, who will run this company, who will get fired, who's on the board. And that's what a lot of companies do when they first go public. And then when they become huge, things change. And now the shareholders own far more than 51%, like with General Electric or, General Motors. A lot of companies have been around a long time. The shares have been out there. Ownership is really owned by the shareholders, or is it just one single family owning it? Ford's kind of a different story. They still have a lot of shares within the family, which is rare for such a large company. So that's the difference between common and preferred. Now, there's another difference. I don't know if a lot of you had intro to business, but one thing you learn in business is if a company goes bankrupt, here's how they decide who gets money. Okay. First, the company probably owes money to their suppliers. Hey, who dropped off that plastic? Who do we still owe money to? They're number one. Then the investors go in this order: bondholders, preferred stockholders, and then common. Hey, we paid off all the bills, the company's shutting its door, and now we have this money left over to give back to the investors. So let's look and see who owns the bonds. These are the people who lent the company money for bonds. They expected a return. They've been waiting and waiting for this company to be dissolved because they knew they've gone bankrupt, and they've been hanging on, waiting to see if they get any money. And they might get some of their money, or they may get all of it. If there's still money left over after the bondholders have been paid, preferred stockholders are next in line. And they hope to get their money back, or at least part of it. And if for any reason, and this is rare, if for any reason there happens to be any money left over after the bondholders and the preferred stockholders get their money, last on the list are the true owners of the company, all those with common stock. And in most cases, the common stockholders are probably not getting anything if there are bondholders and preferred holders also waiting for money. If the company never issued bonds, there's a chance. If they never issued preferred stock, there's a chance. But if all three of them are out there, common stockholders are probably not getting any money. Now, I want to make sure you realize that companies going bankrupt is more common than you think. It's happening every day. And at the end of 2008 and beginning of 2009, there were a bunch of companies. Every day another company was going bankrupt because of the crash that took place. So, when you're investing, one of the things you might want to consider is, if you think that we're in a time where a crash could happen in our future, and it's hard to kind of predict, and you still want to invest in a company, you want to look at if you can find the numbers on the company. And the best place to find numbers, are right here. Let me find this one right here. Yahoo Finance. I love Yahoo Finance. There's a lot of other places, but this one's absolutely free. You can get most of the numbers you need. And what I look at is if you go to, where's financials? Right there where it says financials, and you want to look at their balance sheet. Now, I have not looked at this balance sheet, Remember, on a balance sheet, there's assets at the top usually, then there's liabilities. Assets minus liabilities is the company's net worth, just like I taught you guys to measure your net worth, that you should reevaluate every month once you're working. And so here's their income statement. I want the balance sheet, so I'm hitting this tab right here. And I want you to notice it says all numbers in thousands. So we got to add 3 zeros to whatever we see here, but I always look to see how much cash do they have. How much cash? So in this case, this company, Thor, this is the, hang on, who was it? I gotta remember here. This was Haley, Kay, are you here? We talked about this already, but you moved up again. You went down and then back up. And so this company that's been launching you, Thor, which is called, I forgot the name of it. Thor Industries, that's the name of it. And they do recreation vehicles, right? And after that lecture, you said, let me go to your history. Is it right here? You sold half. You said, wow, it really went up. It's got to come back down eventually. I'm going to get half of it out of there. And you sold it at 129. And it seemed pretty smart, except for it went down and started to come back up again. And it's made it all the way up to, last price I looked, 130. So you're $1 more than when you sold it last time. And it actually lost $1 today. It hit 131 yesterday, or last Friday. So it showed that you had made 12.5% before, that was after it went down $1 today. So you're even higher than 12.5%. So what do you do now? Do you hang on to the 9 you kept? Or do you sell those too? Who knows? So what I look at, if this were real money, and I thought, hey, there could be a crash coming. I want to tell you something. There is some kind of correction coming. I don't know if it will happen before the end of the semester, but this stock market is way overpriced. And there's just so many indicators that say, hey, there's no way it can keep going at this rate. It's hit record highs now, 12 times since this class started, which is usually a buildup to a big correction. Correction means that it will take a fall over a short period of time of about 10% or more. A crash is like 25% or more. And in 2008, it went down like 35% over a very short period of time. So fast, people couldn't get out fast enough to stop losing money. So what I'm trying to say is there's something coming. I don't know when, but what do you do? How can you tell? I was leading this to something. I was about to say something. She has to make a decision. Does he stay in or stay out? And this is the time in which I would look at a company's financials and I go to their balance sheet and I say, okay, how much cash do they have? And I see that this company has about, at the time, this is July, at the end of July, they had, how much is that? 223 what? Help me out. Million. You got to add 3 zeros. These numbers are in thousands. 223 million. And I say, okay, is that enough to get them through hard times? Because that is the one thing where companies make the biggest mistake that causes them, big companies, to go bankrupt, is they don't have enough retained cash saved and put aside to make it through hard times. And that companies make the mistake at the end of each year saying, oh, look at all this cash we have. It's time to do bonuses to the executives. Oh, hey, president of the company who led us to all this cash, here's $1 million. Hey, vice presidents, here's $500,000 for each of you. And they start giving it away instead of retaining it for hard times. And that's what I look for. If I see a company that doing lots of bonuses, that's not one I want to take a risk with. If I see a company has a lot of cash and they're not doing bonuses and they're trying to retain that cash to get them through hard times, then I realize this is a lower risk investment during times like this where it's high risk to invest in anything. So that's what I look for. One company I used to always say is that always will make it through hard times because they have so much cash, and I haven't looked lately, is Apple. Apple lives by that rule of cash, cash, cash is king, and they don't give it away. They hang on and hang on to it. I think they were up to like $1 billion in cash at one time, possibly, or $500 million at least. And
They got like hundreds of billions.
well, are they? Hundreds of billions. So
They got $321 billion in assets right now.
no, not just assets, cash. Go up to cash.
Oh, just cash?
Just cash. All those assets mean nothing.
Like 20 billion.
20 billion? Yeah, 20 billion. Well, that's great. 20 billion will get you through hard times. And so there's an investment, you go, hey, I'm investing in this, I hope to make money off it, but if the crash takes place, I know this company will still be there when the dust clears because they have enough cash to get them through it. They always are preparing for the future in case something happens, and that's what I look for, a company that does that. So you're about to learn some new things to look at when you're thinking about buying a stock for the Investopedia game. I want to go to, let's go back to, let's see, where's all, where am I? Let's talk about this Thor again, but I got to go back to, trying to think, where was I? Is this the page? Yeah. One more? Or can I see the numbers? There we go. Are you ready? So one of the numbers we're going to look at, I'm jumping down to, let's see, where am I at? Slide 12 on the PowerPoint. Let's read about it, then we'll come back. From today forward, any stock you buy for the Investopedia game, you already, for several weeks now, had to write down the what?
Beta.
Beta. Now you need to write down, hey, what's going on? The PE ratio. It stands for price earnings ratio. It starts with earnings per share. A company has profit. They take the amount of profit and divide it by the number of shares that are outstanding that people own, and that's called the amount of profit per share. They call it earnings per share. The abbreviation is always EPS. You'll see it all over the place. EPS. Then they say, okay, here's how much each shareholder's been making in profit, but how does that compare to the price you have to pay for the share? That's called the price earnings ratio. The price per share for that stock divided by the earnings or profit per share. But you've got to have that earnings per share to find this ratio. Or you go to Yahoo Finance where it calculates it for you. So let me backtrack now, back to that stock. Here's Thor. Look for it carefully. I want to start with earnings per share. If you took their most recent documented earnings they made in a whole year and divided by the number of shares, how much are the earnings per share? Anybody see it? EPS. So there it is. $6.41. Each shareholder's, if the profit were to be split up, would be $6.41 for the year for each shareholder. What did the shareholder, well, if you were to buy this stock and this earnings continue at $6.41, what is the price? I can't even see it. Did I block it? What is the price per share? I blocked it. There you go. $130.78. $130.78, or whatever the price was when this was last calculated right down here. There's the PE ratio, price earnings ratio, divided by the $6.41. It has a PE of 20.37. Now, what does that mean? Here's kind of the most common average PE ratio, between 5 and 20, right around there. Now, if a company has a PE ratio at one end or the other end, there's two meanings. So you've got to always look past just the PE ratio. But at least you can look to say, hey, is this company in the ratio? Well, there's only, when the company's PE ratio is not in the average, that's where you got to say, okay, what's going on that's causing this PE ratio to be so significantly low or so significantly high that it's not where all the other companies are. And usually it means, especially if it's over 20, significantly over 20, it means the price of that stock is overpriced. But we live in an open market society, so it's really the price is based on whatever anybody's willing to pay for it. But if you're trying to be an investor looking for value, that's the kind of investing I like. I look for value, something that I know I can make money off of down the road because I'm getting a good deal for it. I'm getting a good price, value. Like when you're buying the cars, you're trying to get the lowest price you can get. I usually wouldn't buy a stock that has a PE ratio that's significantly over 20 because that's already overpriced in value. And I've just put the odds against me of possibly getting value out of that investment. So let's look at this one, 20.37. It's in there. It's not bad. It's in the ratio. It's on the high end. We'd have to look at other things to know what it means, whether it's a good value or not value. Is this a hot stock or not a hot stock? It's been doing well for investors, but the price has gone up to the point, compared to earnings, that it's almost at the outside of the normal range. It looks like it's heading above 20. But look at stocks like, I always bring up Netflix. All right, Netflix, $192 a share. Look at its PE ratio. Anybody see it? Say it out loud. 234. It's nowhere near 5 to 20. But this is like the 4th year I've been showing students a PE ratio for Netflix, and people still buy it. They don't allow that to scare them for some reason. They think Netflix is going to be, every year they think they're the future. That is the whip. But, you know, look, with such a high PE ratio, 234, you're paying for that thought that it's the company of the century or something. And so, for you to make money off this stock, they have to have so much earnings to keep driving that price up, or people just have to you just happen to keep finding buyers for the stock once you're ready to sell that have this, oh, Netflix is the future, I'm buying it. I don't care that it's 234 times earnings. In the old days, I used to say, I'm not going to buy a stock that's more than 5 times earnings because I'm looking for that value. And then I look at other things to see, is this a company that's growing, or is this a company that's starting on the downward trend? Is that why their PE ratio is so low? But when I found a stock that had a PE ratio of 5 or 4 or 6, I'm possibly looking at a good value if it's a company that just hasn't been found by investors yet, and it's on the way up. And then their PE ratio goes higher and higher because the price keeps going up, and I found the value. And that's kind of a good way to find it. If you can find a company with a low PE ratio that maybe investors haven't found yet, and you can see through revenue, well, look, they keep increasing their revenue. Sales are going up. They're not going down. And look, their profit's going up. So they're keeping a control on their expenses. And yet their PE ratio is this low? Wow, here's a good value. So you've got to look at other things. But when I'm quickly looking through stocks, and this jumps out at me, when I see a low PE ratio, I think, could this be a good value? Could this be something that I could really increase my odds of making money quickly? That's what I do. I play the odds, the probability. I try to put the odds as much on my favor as I can. The odds are always on the house. You ever hear that at a casino? The house always has the odds. Well, the market always has the odds. So you're just trying to do the best you can to try to put some of those probabilities in your ballpark by looking at these different things you're learning about. Some of you are going, hey, I don't ever want to look at a PE ratio. I don't want to look at a beta. I don't want to look at an earnings per share. And that's why mutual funds are the way you would want to go then, because at least then you're diversifying and allowing somebody else to decide what should be bought and sold within the portfolio. And a lot of you are going to be forced to experience mutual funds through your retirement program where you work after you graduate. So you've got to get used to, these are the things inside of that mutual fund. And these are the things that mutual fund manager are looking at, because their goal is to try to get that mutual fund to increase in price by more than the percent the overall market goes up. They want to beat the market. That's their goal. Their motivation is that big bonus they get in December if they beat the market. So from now on, write down the PE ratio and the beta when you go to buy a stock. As this is prepping you for your paper, because one of the things you're going to write in your paper is, what is the first stock you bought after you learned about beta? And what was its beta? And what did it mean? And you just say, here's what I bought, the beta was, and here's what the beta means. And now, another question on your paper is going to be, you're going to be answering the question, what is the first stock you bought after learning about the PE ratio? What was the PE ratio and what did it mean? You have to do a transaction in October, and we're getting towards the end, October 23rd. Now, it doesn't mean you have to buy something in October. You can sell something. But I'm assuming you might buy one more thing before December, or before the class ends. So that's why I'm assuming you'll have a purchase where you're going to be looking at the PE ratio, since today's the day. Now you're going to write it down if you buy anything between now and the end of the game. All right. There's PE ratio. I want you to see the calculation, so we're going to earnings per share, 398. All right, bottom of the page, we're starting with earnings per share because that's what's involved in getting the price earnings ratio. Let's assume General Motors had $1,855,000,000. Earnings were $1,855,000,000. We're just making that assumption, 2013. And assume General Mills, General Mills, the company's known for producing consumer food products, and it has 666 million shares. Wow. Earnings per share would be, you take the profit that was reported, $1,855,000,000 profit, not just sales, profit. So they probably did like 10 billion sales. 666 million. Now, if your calculator doesn't go this big, if you take away 3 zeros at the top number, and you take away 3 zeros in the bottom number, you'll get the same answer. As long as you're removing the exact number of zeros top and bottom so it fits in your calculator, you'll get the same answer. So take this divided by this, it's $2.79 per share earnings, meaning profit. If the profit were split up among all the 666 million shareholders, it'd be $2.79. Now go to the top of the next page. You take what the share price is, was currently selling for, and divide it by that earnings per share you just calculated. So it's selling for $82 a share. The earnings per share we just calculated was $3.72. This is still General Mills, yeah? No, Procter & Gamble. This is a different one. Procter & Gamble, their earnings per share is $3.72. The corporation price earnings ratio, $82 divided by 372 is 22. Would you call that low, average, high? It's slightly high. It's over there. It's over out of the range, right? That you just learned about. So it's just a little bit high, slightly high. And you may say, is it high because this company is on the way up and investors found it already and they've been driving the price of the stock up and I want to get on board because there's still more to go up? Or is it high because their earnings have gone down, which makes the earnings per share go down, which then causes it to really not be that good of a value because the price is already higher than it should be compared to the earnings that are being made for the shareholders. That's how it's read. The number could have two meanings no matter where it's at, and you've got to look at the other things, but it can grab your attention as to where it's at. And companies that are down here like 5 and 6 and 4, they grab my attention for me to look at other things because I go, maybe this is a good value. Maybe investors haven't found this yet. Maybe I could jump on it before everyone else does. So I look to see if there's been news articles out. There hasn't been any news lately. Maybe that's why investors haven't been driving this price up. I could be the first one because it looks like this company's on the rise. Their revenues are going up. Their profits are going up. Earnings per share is pretty good. And then usually that's the kind of one I'll take a little risk on. I used to a long time ago. I don't get into it anymore as much as I used to. All right, so that's how it's calculated on those pages. Here's that quick. I want to do one more example. This one was Netflix. I thought I had one more here. I do. Here we go. Ford Motor Company, $12 a share currently. Whoop, hey, get rid of that. I'm trying to, without starting some video. How do I stop this here? Anybody see pause? How was that? All right. You ready? Normal, low, high PE ratio. Average, normal, high or low? Average. What is it? 12.73. It's almost right there in the middle. Pretty average. So we don't know what's going on there. It doesn't really grab my attention, what's going on, but it could be still a good value, but it looks like investors may have found it already. Earnings per share, 95 cents. And you divide that into the price, it's about 12.73 times the price. So there's another example. Ford Motors, pretty big company with a lot of shares. so you can see how easy it is to find this. Look at this right here, ex-dividend date. Oh, that reminds me. Let me go to Thor for a second. Let me go down here for the news. I read something. Where'd it go? Right here. Where is it? I just had it. This recreational vehicle manufacturing company says their common stock, let's see, this is 3 days old, but they raised their dividend by 12%. So shareholders are going, oh my God, the dividend's going up. A bunch of new investors are going, we want to get those shares. The dividend's going to be higher. But on October 23rd, is that tomorrow?
Today.
That's today? The shares are trading ex-dividend. That means, if you're just reading this now, if you caught it 3 days ago, you probably had the chance on Friday, if this came up before they probably didn't do it before the stock market closed, they probably did it after. But if you try to buy this stock, when the market opens on October 23rd, you're buying it knowing it's ex-dividend, meaning you don't get the dividend that's about to be paid with the stock. The person who's selling it gets to keep the dividend when it gets sent out. That's what ex-dividend means. So they held it for, they probably do dividends every 3 months, or maybe it's every 6 months, and that person probably held that stock for a long time. And if they want to sell that stock, then you need to realize it's being sold ex-dividend, and that affects the price a little bit, knowing you're buying a stock that you're not going to be getting the dividend that's about to be issued at a 12% higher than previously, that the person who's selling it's going to get it because you waited till October 23rd to buy it, and the dividend's about to come out within a week or two or whatever. So that's what ex-dividend means. And that's important because a lot of people will, who don't understand ex-dividend dates, they'll go to buy stock thinking, oh, look, I got this stock and we're only 4 days away from getting the dividend. What a great deal this was. I only have it for 4 days and I'm getting the dividend. And then they don't get the dividend. They go, what's going on? This is why I bought the stock. The previous owner gets it because you bought it either on or after what's called the ex-dividend date. We're going to talk about that again a little bit on Wednesday because that is one of the sections of your book, and I usually have at least one question about what the ex-dividend date means. If a stock's being sold, blah, 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 blah. So now I want to go to, we're here. We're going to go to slide 3. Right. Okay, why do companies issue stock? The number one reason they issue stock is they need money. And they find that maybe issuing stock could be a cheaper way to raise money compared to going to get a loan. And what's nice about issuing stock, even though they are giving up some of the ownership of their company, but as long as they hang on to 51%, they're not giving up control in any way. They're just giving up some ownership, which does have meaning, but they never have to pay it back. If you ever watch Shark Tank, they'll go, I am asking for $100,000 for 20% of my company. You ever hear those? They're saying 20% is a fifth. They're saying $100,000, you get a fifth of my company. The other 4/5 are worth $100,000 each, so that's $400,000. So they're saying that their company's worth $500,000 total if they were to sell it at that minute or go out of business or what they think it's worth. And they're asking for $100,000 and they'll trade 20%. Now, why would an investor want only 20%? They have no control, no voting, no direction. They could advise the person who started this company who's selling 20%. They could advise them, and hopefully that person will take their advice. But if that person doesn't want to take their advice, there's nothing they can do about it. They own 80% still. They only sell off 20%. What happens, though, is if the person who has the 80%, you ever work anywhere, I'm trying to think of a small business, and you ever been at the cash register, and the owner comes in all of a sudden out of nowhere, goes to the cash register and says, God, I need some money, and grabs some money and puts it in their pocket and leaves right out of the cash register. You go, how do they do that? Well, it's their company, right? It's their money. But really what they did is what's called a dividend distribution. That money gets accounted for in accounting. And if any owner has a dividend distribution, even a small company, if it has multiple owners, and the person walked in and said, I need $100 right now, takes it out of the cash register, knowing accounting will account for it, right? Oh, that's where the 100 went. They wrote a note, they put it in, the 100 disappeared, the owner came in and took it. If any owner gets a distribution, that same distribution, based on the percent of ownership, has to be distributed to the other owners. And that's where the 20% owner the Shark Tank investors get their money. It's the person who started the company is not incorporated, so they're on a salary. There's always has to be salaries. Any money given to that owner above the salary that's been agreed upon is called a distribution. So when they walked in and took that $100, let's call it $80. Another $20 needs to go to that person who invested $100,000 for 20% of the company, because that person owns 80% out of $100. 80 of it they took as a distribution. Well, now they owe a $20 distribution to the 20% owners. So any time a distribution takes place like that, the other owner has to get their share. 20% ownership, $20. 80% ownership, $80. Because $100 got taken out of the cash register. And that's how it's done. And that's how they get their money back through, wow, look at how much profit we made this year. Let's do some distributions of dividends. Here you go, you still own 60% of your company, so we're going to do $10,000. Here's $6,000. Now you have these other investors each owning 20% each. Here's, $20,000 for that person. Here, or I'm sorry, $2,000. Here's $2,000 for that person. 20%, 20%, 60%. There's the $10,000 being distributed. It's over and above the salary. And that's how investing in a company, and that's how it would be with shareholders. When money gets distributed to any shareholder, all shareholders have to get their equivalent share of the money being distributed. Now, companies who sell that stock and trade for equity, they know that if they do a dividend, they got to pay it out, but they never ever have to pay back the money they received for those shares. And that's the advantage of doing equity financing, because they never have to pay it back. If they went and borrowed it from the bank, yes, they still own their whole company. And now if there's any dividend distribution, they still have 100%. They didn't sell off 20%. But they have to pay back that loan. They're making payments, and there's interest being charged. Hey, we issued bonds. That's fine. They have to pay back the bonds at maturity, but meanwhile they're paying every 6 months interest on those bonds to bondholders. Hey, we issued preferred stock. That's fine. But they have to give the dividends to the preferred stockholders. Common stock, they never have to pay the money back. If a common stockholder went ahead and said, I'm going to own part of your business, they have to find a buyer for those shares they bought if they want to get rid of them. And it could be the original owners that sold it in the first place, or it could be have to go to the open market. If a company starts to become big enough that they have lots of shares, there's lots of owners, now it starts trading on the open market, which makes it a lot easier to find somebody to buy your shares. If you notice in the game, it does take a little time for you to sell shares. Anybody sold shares yet? It took a little bit of time, maybe a minute or something, but that's how it is in real life. It takes maybe 30 seconds, a minute, sometimes 5 minutes. If the share's obscure, meaning there isn't a lot of people looking for it to buy it, it takes a while to sell, even on the open market. But if it's a very common that a lot of people buy, when you said click, I want to sell these 100 shares, it probably went really fast. And it showed up. I don't know if anybody experienced a longer amount of time or short. What was it?
About 10 minutes.
Oh, it took 10 minutes. So it was a share that wasn't quite as common, or it could have been the game. Who knows?
I think it was just, it was Apple. I think it was
Oh,
just
yeah, Apple. Millions of shares every day are being traded, so that's surprising. Because the game usually reflects real life, and they see the volume being moved. And there's a thing I turned off, that if you are trying to sell shares that are not trading in the real market, it's taken days for some students in the past to sell them because it was such a odd share that not a lot of people are buying in the real market. So I turned that off. I finally realized I can turn that off because I'm getting tired of students saying, I'm locked. I can't stop this. I don't know how to reverse it, and it's not selling. It's been 2 days, and my shares haven't sold, and stuff like that. And that's because it's a share nobody's ever even heard of. So that's why some companies will do this. Hey, I'm going to issue common stock. I'm going to go public, but I'm only going public with this many shares. There's this many total. I'm keeping 51% or more. I'm going public with the rest. They can join in. If there's dividend, if we make a lot of profit, they'll make a lot of money, just like I'll make a lot of money. The owners saying to themselves. So that's how that works. Next, we're going to, here is the reason why, or here's the rights of anyone owning common stock. You have voting rights and control of the company. In return for investing in a company, a stockholder, common stock, not preferred, common stock, have voting rights. You get what's called a proxy in the mail. That's what those are that I told you you're going to get once a year. And if you don't send it back, at least abstaining, you're going to get another one in the mail in about a week. And then another week goes by, you get another one. They will bother the heck out of you until you finally say, look, I don't want to vote. Abstain. I'll let someone else decide who's going to be on the board or whatever the big decision is that's on that proxy. And you send it back. And they give you a stamped envelope. You don't even have to put a stamp on it. Just get the thing, sign it, send it back. So, want to make sure you're aware of that. We're going to, right here. How do you make money off stocks? Almost very similar to mutual funds. Darn close. Either you're going to get dividends, because some companies pay dividends to common stockholders, some don't. But a lot of investors love the companies that pay dividends, so that those common stocks are usually much more common, because investors love dividends. Or you can sell that stock for a higher price than what you bought it for, called the capital gain, just like the mutual fund. But what you'll never see here is what's called a capital gain distribution. That doesn't take place on just a single stock or a single company. That takes place in a mutual fund because of buying and selling stocks in the mutual fund by the mutual fund manager who had capital gains who then distributes them. This is, all you have is income from dividends and appreciation of the stock price, which would be a capital gain. And don't get me wrong, that stock price could go down. You could have a capital loss, which you get to write off against the gains that you made on other stocks on your taxes. You get to deduct your losses. So you don't have to pay taxes on the other gains if you had a loss on another one. All right? Now, when you buy a stock, you hope it pays dividends, you hope it goes up in value, but now this is a long time ago. If you were able to find out about a stock that's going to split, and make sure you understand what a split means. The most common split is what's called a 2-for-1. For every share you own of the old stock, we're issuing new stock at a 2-for-1 split, and you get 2 shares of the new stock. So you own 100 shares of Ford stock, and they're doing a split. Matter of fact, Apple did a 6-for-1 split about a year or two ago. And you go, okay, I own 100 shares of Apple, and they're doing a 6-for-1 split. Your 100 shares just turned into 600 shares. But I want to stick with 2-for-1. You own a stock, let's say you own 1 share. All right? And that share, you paid $50 for that share. And all of a sudden, you find out, maybe you got a letter in the mail or something, and you find out that the stock is about to do a 2-for-1 split. For every 1 share, the last number is however many you own, for every one of them, you're going to get this many of the new shares after the split. So if you own 1 share and you paid $50 for it, it now turns into 2 shares. How much is your total investment to start with for the 1 share? $50. And let's say its price is $50 at the moment that split takes place. The price changes. You still end up at the moment of whatever the value is of however many shares you have at that moment. After the split, the value is the exact same. So if you have 1 share that's worth $50, and now all of a sudden you have 2 shares, but the value's the same, what do you think the price per share is? That's right, $25. You have 2 shares at $25, which equals $50. Before the split, you had 1 share at $50. The value's the same. Your value was $50. The split took place. Your value's $50. Now, if you're not taking good notes, the most common mistake here is the student will go, oh, 2-for-1. My shares are going to double. And they automatically think the price will double. The price goes the opposite way of the shares. If the shares are increasing, for example, 2-for-1, then the price is decreasing. They're in opposite directions. Now there's what's called backward splits. 1 for 2. For every 2 shares you own, it turns into 1 share. It's going down in shares, which means the price then would go up. The opposite direction is how that goes. But the value, whatever the value was before the split, that is the same exact value at the moment after the split. Now, I want to tell you, back in my day, this is a long time ago, when I was heavy into investing, every day watching, I was obsessed, obviously, and I would say, oh my God, this company's going to take a split. And every time in the past, when I saw a company take a split, the stock price jumps down that morning that the split took place. And all of a sudden, I see the stock price going up kind of aggressively because a bunch of people are buying it. And what happens is investors will all of a sudden go, hey, look at the price of this stock. This could be a good buy. I don't understand why it's that low, but I'm grabbing some. And they're forcing the price up, not realizing that it is the same value that the stock had split. And so if you knew of a split coming and you grab some of that stock, the day the split takes place, you're going, look at this price going up, and then you turn around and sell it, and that's called making a quick killing off the knowledge of a split. This was before computers. I mean, where everybody had computers. Maybe the broker had a computer, but I didn't have one in my pocket like I do today. And so it's a lot easier to get information now than it was back then. A lot easier. And so you don't see that as much as you used to see it. But it was an easy way to take advantage of having knowledge. Knowledge is the key. The more knowledge you guys can gather and put together, and obviously you're not as interested in this as maybe something else, but the more knowledge is the more you can capitalize on that. And when it comes to investing, this is the kind of knowledge, increased value from splits, that paid off for me. The other one was knowing which way bonds would go when interest rates are changing. So real quick quiz question I know you're going to have. Interest rates are going up. Should you buy bonds or sell bonds? Interest rates are going to go up. Should you buy bonds or sell bonds if future interest rates are going up?
Sell them?
Get rid of them. The time you want bonds and when interest rates are going to go down in the future. That's a golden rule. You guys got to get that one down. That's an easy way to make some money.
So after we talked about that in class, I switched all my money.
Getting out of the bonds?
Yeah.
Because you thought interest rates were going to be going up, right?
Yeah.
But if we have a crash in the market, you want to switch back because if they lower interest rates to stimulate the economy after some kind of crash.
Can't really lower them any more than they.
Yeah, hardly. But they've gone up 2 or 3 times in the last year and a half, I think.
Yeah, like a tiny.
Yeah, and they will go back down those 2 or 3 amounts too.
Yeah.
If a crash takes place.
0.25%.
And it's possible, if a war starts, anything can happen. One more thing I wanted to mention about making money on stock. I want to go to slide 13, those who printed. Here it is listed, how much dividend, okay, there's 3 things real quick. But total return is a question on stocks just like it was on mutual funds. Hey, you bought this stock, you have 100 shares, it paid this much in dividend per share, here's how much you sold it for. You need to calculate the amount of gain from your initial investment. How much money did you make off it? So you bought a stock, 100 shares. You owned it for exactly 1 year. It paid 22 cents per share during that year altogether in dividends. Let me write dividends. And how much did you buy it for? You bought it for, what was that one? $18.50. And you sold it 1 year later for $20. What is your total amount gained, and what is your percent gain? Those are the 2 things you got to get used to. I always start with, how much did I get in total dividends? 100 shares times 22 cents a share, 0.22 times 100, I move the decimal 2 places, equals $22. There's the dividend part for the year, right? Then the difference in price. I sold it for $20. I bought it for $18.50. That's $1.50. $1.50 profit times 100 shares equals, move my decimal, that's $150. I add my dividends of $22 for the year, my gain from selling it for more than what I bought it for of $1.50 per share, and I get $172 total profit off that investment, right? For the year. It says 12 months. To turn it to a percentage, you got to go back and say, what was my initial cost investment to get these shares? So what do I take? 100 shares times what? Anybody? show you. 1850. So 1850 times 100 shares equals $1,850. There's my total investment. Take my profit for the year of $172, divided by that initial investment of $1,850. 172 divided by 1,850 equals point something. Calculators, point what? Point 1, point 1, no, point 0.25. 0.092. 0.092. Move the decimal 2 places. Or times up. What? Is this wrong?
0929.
Oh.
It would be 0.093.
3.093. Thank you very much. Move the decimal 2 places. Add the percent symbol. 9.3% gain. What is the total amount of return on this investment? $172. What is the percent gain on this investment for 1 year? 9.3%. If you don't like moving that decimal 2 places and add a percent symbol, leave it in the decimal 0.093. But don't just add a percent symbol without moving that decimal. That's definitely a completely different answer. All right? Now, this is no different than the mutual fund, except for if the mutual fund may have had one more number to add to it, which would have been capital gain distributions, which you don't get with individual stocks, because your capital gain is only on the sale of it. All right, now we're going to, one more time on stock splits. I want to make sure you get this. It's a 3-for-1 stock split. The stock is trading for $210 per share before the split. All right? The question is, after the split takes place at that moment, what will be the price per share? Can't hear you. Everybody hear it? 3-for-1 means for every share you have, you're getting 3. So the amount of shares you have are going up. The price has to go in the opposite direction. So the value here, if you own 1 share, is $210. Now your 1 share turns into 3 shares. But the value still has to be $210. So 210 divided by 3, $70 per share at that moment that the split takes place. It gets divided by 3, 1/3 the price, because 3 times the shares. If you had 100 shares, it turns into 300 shares. But the value of those shares did not change. The value of all the shares you had, even though you had 100, now you have 300, is still the same value, because the price at the same moment goes down as it correlates to the number of shares. So same thing if this were a 6-to-1 split, like Avila did a couple years ago. Why companies do splits? They feel that is a psychological reason to attract more investors. That a lot of companies feel that people don't want to just buy 2 or 3 shares because the price is so high. $500 a share. Oh, I want to invest $1,000. I can only buy 2 shares. So they do the splits to bring the price back down at a level that will attract more investors who have that psychological block that they don't want to own just 2 shares. So if they brought it down to $100 a share, now the investor owns 10 shares with the $1,000 investment instead of only 2. So that's really the main reason that used to be done in the old days, and still today they still do it. Because of that is the main reason. So we got total return, we got dividend yield, and now book value. If you're taking notes on book value, I want you to write this word next to it. Net worth per share. Net worth per share is the words next to book value. That's my definition. The net worth of the company per share. Now, you've all learned how to calculate net worth. It's your assets minus your liabilities, and there's your net worth. The company's the same way. It's the company's assets minus the liabilities, there's their net worth. But the difference is they divide it by the number of shares to get what the net worth is for each share, called book value. What's nice about Yahoo Finance is it gives you the book value if you search hard enough. So is this Thor? Here's that company, Thor. You go right here where it says statistics. And you go down here, you You gotta go all the way down, come on. There's management effectiveness. There's a whole bunch of numbers you could use, but way down here, right there, where I'm pointing, book value per share, $27.99. This Thor company is $27.99. At the date this was calculated, if the company said, stop, no more payroll, no more expenses, no more overhead, we're gonna pay off everybody, this is how much each common shareholder would get if that company were to close that day. It's like a balance sheet, assets and liabilities is a snapshot, as if at that moment, if that company were to go out of business right then, this is what it's worth per share. So as an investor, you're going, okay, you know, $28 a share, so I'll give you $28 for a share. I mean, that's what it's worth right now. If they can increase the net worth by, how do we increase our net worth? Either we try to get a job that pays more money so we can put the money aside, or we lower our expenses. We call up and say we don't want a $70 cell phone bill anymore, but I want to pay $30 a month for my cell phone bill. You'll increase your net worth because you just saved $40 a month. We're buying these shares hoping that net worth increases, because if this net worth, book value, increases, the price of the stock will increase, and we'll be able to later on sell that stock for more than what we paid for it, which is the whole goal of buying stocks, to make money off it. But notice, if anybody takes time and starts looking at the book values of, pick like a random 10 companies, and then they compare that book value right there, $27.99, call it 28, to what the stock's really selling for. Nobody's going to let me buy their stock for $28 because look at what it's selling for. Do you see that? Many years ago, when I was into this, my goal was 3. I didn't want to buy a company unless their price per share was 3 times book value or less. $130 compared to 28. Luckily, they give you that calculation. And here, right there, this last subject at the bottom called price to book ratio is right here. Price of the stock per share divided by its actually value if that company were to close today per share. And 4.66, which is lower than most actually. Thor is kind of close. It's so hard to find a company that's only 3 times, that their stock's only selling 3 times compared to what it's really worth. It's very hard. And like the new target is more like 5. If you can find one at 5, it might be a good value. You compare it to the PE ratio, the beta, to see what the risk is, and so on, the volatility. Let's look at another company. Let's look at Netflix. Where's their stats? Hang on, let me go to, what do you guys think, that this price per book will be higher or lower than Thor? Look at their book value per share divided into the price per share of, what was it, 200 some or 500? How much was it per share? Anybody remember? 191, thank you. 26 times. And investors are still willing to buy it, even though it's already priced over 26 times what that stock is really worth. If Netflix were to close today, hey, we're done. We're going to split up the money among all the shareholders. Every shareholder would only get what book value is. And the stock is selling for 26 times. Now, I know there's people saying, oh, I want Netflix because it's going to go up because they're switching this and they're raising their prices and they're going to have more revenue and have more profit and stuff. But it's, you know, this will end someday. There's going to be a day all companies get back to normal. And I don't know how this keeps doing it, because this is like the 3rd or 4th year that it has outrageous numbers, but it will get back to normal. A lot of newer type growing companies have these numbers and they get back to normal. Look at Apple. Apple was the same way back when the iPhone first came out. It's back to normal though. Its PE ratio's got to be somewhere near normal. Its price to book has got to be somewhere closer to normal. Let's look at the book value of this of Netflix. There it is, $7.21. It has assets, and subtract all the money owed and divide by the number of shares. Each share is only worth $7.21, and yet you have people saying, yeah, I'll take a share for $191.85. These are the kind of things that some of you who are going to get into buying individual stocks, you got to make sure they know you got to look at. All right, so what was the target on price to book ratio? What's the target to compare it to? To know whether this is high or low. Say it again. 3. You're comparing that to 3. That used to be like the high average. Now that's kind of the low average.
Well, I was gonna ask if that's the average, if that's the goal. So that's like kind of the
It's
goal.
about average, 3-ish, kind of the low end of average right now is 3. 3, back in the 80s, when I was, in 90s, when I was heavy investing, that'd be anything, significantly over 3, I'd say, oh my God, that price is outrageous. Why would anybody even buy that? They're having to pay 26 times what it's really worth. What if this company goes out of business? They're gonna lose 26 times their money. I mean, 1/10 is all they're gonna get back. 90% of their money is gonna be gone. Anyway, so you gotta look at that. Netflix is probably not going out of business. I don't know how much cash they have to. Is that one we look at? Let's look at Ford. Let me get their stats. Let's see what their stock price is compared to book. Ford's been around so long that it's probably got to be darn closer to normal than Netflix. That's for sure. Where is it? Price to book ratio. You see it? Hey, we may have found a good value. Let's look at the PE ratio. This may be a good value. I know that Ford has a new CEO. And that CEO is doing some cost cutting. And if these cost cutting efforts by the new CEO take place, we're going to see the price per share go up, and we're going to see the earnings go up, and we're probably going to see this start to go up. But this right here jumps out at me. It's so far below 3 that it's saying if Ford's on the way down and sales are not going well at all, then it's warning me. But if sales are going up and cost cutting efforts are starting to take place, then it's jumping at me saying, hey, here we go, here's a good value, here's something we can make some money on if truly all the things that are said are going to take place really take place. And that's where these numbers kind of help you. If you're going after, when you guys get out there and start working, you're going to go, oh my God, it took me 5 years to save $10,000. Oh, I'm never going to get to that million. Never. You want to start getting aggressive. Hey, I've saved this money. I'm just going to take a 2,000 of it and take a little risk with it. These are the kind of things you want to look at, or you're just throwing your money away. Because you're trying to figure out a way to make more than the average from all that money you worked so hard to save. And you made sacrifices to be able to say, look at what I did. I didn't spend that $10,000 these last 5 years. I skipped that vacation. I didn't go to that part, all those 10 parties that I would have spent $50 in each one. So I want to make some money. I want my money to work for me as hard as I'm working for my money. And that's where, unless you have a concept of what to look for, you will be throwing your money away, just like going to a casino. If you're just saying, oh, I think I'll go with Ford, or I think I'll go with Netflix, without knowing what you're doing, investors love you, because you're going to end up losing, they end up winning. There's winners and losers, and it's the ones with the least knowledge or ability to understand what they're doing are usually the losers. They may get lucky at first, and they'll get addicted, and they'll go, oh, this is easy money. And then they take a big loss, and they realize, oh, I didn't know what I was doing. And the ones who did got the big win. They got your money. So that's how it works. All right, so we're writing down price earnings ratio. We're writing down price to book ratio on anything we buy after today. We've already been writing down beta. We already talked about we're writing down PE ratio. And now we're going to be writing down price to book ratio. And if you can't find it anywhere, just write that down. Just keep good notes, though, because when you do your paper at the end, it's going to say, hey, after October 23rd, what was the stock you bought, what was its PE ratio, what was its price to book ratio, and what did it mean to you? These numbers that you found. Just showing that you looked and that it had meaning to you a little bit. And what did it mean? Okay, I think we covered everything on the list. We'll pick up, everybody sign in the sign-in sheet? Where is it at? Back here? Okay, anybody need to sign in? It's back here in the corner. You didn't sign in. I'll see you on Wednesday. If you came in late, I passed.